Who's most vulnerable out of the markets that you look at?
Hi, good to be with you. Well, we've been cutting our growth forecasts around the region as the depth and severity of the virus outbreak continues. And in terms of who's most vulnerable, it's really economies who went into this crisis with very high debt burdens and therefore have little space when it comes to proactive expansionary fiscal and monetary policies. And those tend to be the credits in Asia-Pacific at the lower rating scale, particularly some of our frontier markets, such as Sri Lanka, which we just downgraded on Friday.
You've done, in fact, 18 downgrades of EM sovereigns in 2020. This is the highest annual total in just less than 4 months this year. Are there expectations that things will be getting much worse?
Well, I don't think we're done quite yet with negative rating actions, certainly not globally and possibly around our neck of the woods here in Asia-Pacific. We do think that the second quarter of the year in terms of growth outturns is going to be very severe. And we're looking now at an economic downturn that's twice as severe as the 2009 financial crisis. So it's something that's really unprecedented that we haven't seen in a long time. As I mentioned, it's economies with the high debt burdens that we'll be watching most closely. The likes of Malaysia went into this crisis with high debt load. You were just speaking about Japan. Japan has the highest public debt burden of any sovereign we rate. India, another large emerging market economy with a very high public debt at over 70% of GDP. Other than Malaysia, which we have a negative outlook on, the ratings for India and Japan are stable at the moment, but we're going to be watching given the fiscal responses and the upward pressure that's going to put on public debt burdens.
How much is the plunge in commodity prices also being amplifying the negative effects on these emerging economies? Right now, Goldman Sachs saying that metals are poised for a substantial sell-off still, and that when it comes to global oil, their storage capacity will be tested in about 3 to 4 weeks, which means we could see further pressure on oil prices.
Right. So globally, emerging markets do tend to rely heavily on commodities. So the plunge in oil prices and commodity prices for exporters of those products is putting pressure on their economies and their ratings. And also U.S. dollar strength is also putting pressure on economies' ability to foot the bill for their debts in U.S. dollar terms. Now, around the Asia-Pacific region, eventually the low energy prices will help boost economies when demand picks up. We have just a handful of commodity exporters. Those are Malaysia, which is a big oil and gas exporter, Indonesia, a big commodity exporter, and Mongolia. So in those three economies in particular around the region, the low commodity prices is weighing on both exports and fiscal revenues.
And Stephen, what about those economies that already had a negative outlook coming into this year before even the pandemic, like Hong Kong and Macau? How does this added pressure on their economies bode for their outlook?
Right. So we did have negative outlooks going into this crisis already for Hong Kong, Macau, and Sri Lanka. As I mentioned, for Sri Lanka, this last Friday, we did downgrade to B-. We maintained a negative outlook on Sri Lanka. Hong Kong, just over a week ago, we followed through on that negative outlook with a downgrade to AA-, still a very high rating, but that's 2 notches lower than we were last September. And Hong Kong, of course, is dealing with multiple pressure points, the social unrest, the legacy of that from last year, the hit to tourism from the virus, and the expectation that we're going to continue to see social unrest, which really hasn't been resolved, and also the ongoing integration of Hong Kong and China and the implications for governance in Hong Kong. Macau, we've left on a negative outlook at AA for the moment, but those are all still at play as this crisis evolves.
Stephen, how robust can a Chinese recovery be in isolation when we're expecting significant weakness across the rest of the world and its trading partners?
Well, we are seeing China beginning to normalize. Certainly, capacity levels are well below full capacity, but we are penciling in continued positive quarterly growth momentum in China through the rest of the year. We think full year growth in China will be below 1%, but underneath that is the expected resumption of positive growth through the year, and then a much stronger rebound to above 7% in 2021. Now, that's going to help the region, but the region, without other global economies, particularly in the Eurozone and the U.S., picking up steam, the external sector will continue to weigh on growth around the region. I should also say we are, for the region, expecting positive growth momentum to resume gradually in the second half of the year and stronger rebounds in 2021. So that's good news for the region. But even with those pickups, we may not see GDP levels recovering to pre-crisis levels until late in 2021 or even into 2022.